Good morning, everybody. It is 10 o'clock on Wednesday. It's time for our weekly webinar. Good to see you all. Today, we are going to talk about tax-free exchanges that are potential from different accounts and different type of investments in our financial focus. So there are different ways to transfer funds from IRAs, Roth IRAs, retirement plans, certain investment accounts, types of investments, where you transfer the assets from one account to another, and you don't have to sell and realize gains. You can transfer to another similar investment. So we're going to go over that at about the 30-minute mark today during our financial focus. So let's start, of course, with our Slott Report. So we've got a really interesting article today, and it's talking about tax-free distribution. So I'm going to share my screen with you here, and we can read along. So the article is written, and it was released today by Sarah Brenner, 5 Steps for Tax-Free Roth IRA Distributions. And, this is, we get into the 5-year rule here, and it's really helpful to be able to remind each other of these things from time to time. So Sarah writes, the benefit of funding a Roth IRA is availability of tax-free distributions in the future. You pay taxes now on your contribution or conversion in exchange for tax-free earnings down the road. So we all understand that's the deal with Roth IRAs. The rules can be complicated. Don't miss out on Roth IRA benefits by making mistakes when you take a distribution. Here are 5 steps for tax-free Roth IRA distributions. First, follow the ordering rules. For tax purposes, all your Roth IRAs are considered one Roth account. There is no tax benefit gained by keeping Roth conversions in a separate Roth IRA from your contributions. This is sometimes called the aggregation rule. Funds leave your Roth IRAs in a certain order. Contributed amounts are distributed first. Converted amounts are distributed next. First in, first out. Last would be earnings. So this section is a little confusing because it says follow the ordering rules. I don't know how you wouldn't follow the ordering rules when this is how the IRS considers these distributions from the Roth accounts. But the ordering rules are really important to know because people get hung up on this 5-year rule, and it is definitely something you should pay attention to. But the truth of the matter is you'd have to burn through all of your contribution funds that you've put into your Roth IRAs, your converted funds that you've moved into your Roth IRAs, and then begin distributing any gains before you could run afoul of the 5-year rule. With the exception, of course, is if you're under 59 and a half, there are some special rules for conversions, and we're going to talk about that in a moment. So number 2 here, your contributions are always available tax and penalty free. Not only do your contributions come out first, they are always available tax and penalty free. This means that if you need to tap your Roth IRA, you can easily access contributions without adverse tax consequences. Number 3, watch out for the 10% penalty on converted funds. This is what I was talking about a moment ago. Converted funds are always distributed tax-free. This makes sense since you already paid taxes when you converted them. However, amounts that were taxable at conversion may be subject to 10% to the 10% early distribution penalty if you're under age 59 and a half at the time of the distribution and the conversion was less than 5 years ago. So, I always like to some of these rules aren't always logical, and many times they aren't, but this one's pretty logical. So if you think about it, when it comes to under 59 and a half, well, when you do a conversion from your traditional IRA to a Roth IRA, you pay tax. And then it has to stay in that Roth IRA for at least a period of 5 years, and you're 59 and a half, to remove those converted funds out of there. So the reason for this is because, it closed a loophole. People were, when Roths first came out, there was an ability to convert funds from a traditional IRA into a Roth IRA, take a distribution, pay the tax, but not pay a 10% penalty. So this requirement closed that loophole. Now, most of our clients are above 59 and a half, so this doesn't apply. But again, I want you to pay attention to the fact that this is just for those folks under 59 and a half. So Sarah goes on to write, and we're right here at this, if you're following along or reading along, this 5-year clock begins separately for each conversion. So that may be a reason to have, if you're under 59 and a half, that may be a reason to have individual and separate retirement accounts or Roth accounts, even though the aggregation rule says they're all counted as one. Since you have different clocks for your conversions, you may want to have several different accounts for your conversions if you're under 59 and a half. This 5-year clock begins separately for each conversion you do. As I said, what if you are over age 59 and a half when you take converted dollars from your Roth IRA? Then you have no worries about this 5-year clock. So again, this is very specific to those under 59 and a half. I always say that the 5-year rule is very confusing for most people. When you're under 59 and a half, it gets really easy over 59 and a half. If you've had any Roth IRAs, and Sarah will go on and talk about this, but if you're over 59 and a half and you've had any Roth IRA for at least 5 years, then you're free and clear of the 5-year rule. So number 4, know when earnings are tax-free. Earnings are not subject to tax if the distribution is a qualified distribution. Your distribution is qualified if it is made after you have owned any Roth IRA account for 5 years and you are over the age 59 and a half, you are dead, disabled, or taking the funds for a first-time home purchase. So there are some exceptions to being under 59 and a half and having these funds being qualified. You have to no longer be with us, disabled, or taking the funds for a first-time home purchase. Number 5, understand the 5-year clock for qualified over age 59 and a half distribution of earnings. The 5-year period for qualified distribution of earnings can be confusing. It is different than the 5-year period for penalty-free distributions of converted funds discussed above. It does not restart with each Roth IRA contribution or conversion. If you contributed $1 to your Roth IRA in 2020, for example, and then in 2022, you converted your $1 million traditional IRA to a Roth IRA, then as of January 1st, 2025, all the Roth money would be considered to have been held for 5 years. Your original Roth IRA 5-year clock began on the first day of the year for which the first dollar of Roth contributions was made. And it's an important note here that Sarah shows us this. I'm just going to highlight this if you're watching this January 1st, 2025. So all Roth IRAs are considered to be opened by January 1st of the year that they were established. So what that means is December 30, even if you open a Roth IRA on December 31st of 2025, you have almost 1 year into that time clock already for your 5-year rule requirement. So even if it's the very last day of the year, you basically have 1 year under your belt already. Okay, so coming back now, so that's the Slott Report today. We are going to talk about the markets. So let me first share with you what returns we saw last week. So this is as of the week ending October 3rd, 2025. So Friday, October 3rd. So the Dow Jones Industrial Average was up slightly 1.11%. Coincidentally, the S&P 500 was up 1.11%. The NASDAQ was up 1.33%. Now, let me give you year-to-date numbers on those three indices, those broad U.S. indices I just talked about. So remember, the Dow Jones Industrial Average was up 1.11%. The S&P 500 was also up 1.11%. The Dow Jones Industrial Average is up 11.34% for the year. Really great year. The S&P 500 is up over 15% for the year, 15.3. The NASDAQ, as I said, was up 1.33% last week, is up 18.6% for the year. What about the rest of the world? Well, the rest of the world, not excluding the U.S., was that the broad market was up 2.69% last week, is up 27.93%, almost 28% for the year. And I know I've said this before, but I'm going to say it again. This is why proper asset allocation is so important. I had a conversation with someone who attended a class, and they were talking about the S&P 500, the S&P 500, the S&P 500. Well, if I just invest in the S&P 500, if I just invest in the S&P 500. Well, that is a very Susie Orman thing to say. The thing is that when you just invest in the S&P 500, yes, you've got some exposure to the U.S. markets, but you have a whole other world that you're potentially missing. And there are times when that whole other world is going to outperform the S&P 500. Now, in this year so far, as of October 3rd, that's the situation. So you don't want to exclude opportunities. Understand the risks and whatnot, but you want to take advantage of all the opportunities that are out there. Emerging markets, so world emerging markets, 3.66 for the week last week, 30.81% for the year. Europe, Asia, and the Far East, 2.72, 27.78% for the year. So 2.72 for the week, 27.78 for the year. How about the bond markets? The bond markets were up slightly, so interest rates are trending down. That's going to raise bond prices. So the U.S. aggregate bond index was up just about 0.5%, 0.46% last week. Is positive 6.39% for the year. So again, that is the U.S. aggregate bond market. Maturities of about 7 to 9 years, and I would say, as I almost always do, that's probably where most of the people have their bond holdings when you're talking about a 60-40 portfolio or 70-30 portfolio. Then we have the U.S. aggregate 1 to 3 year bond market, and that was up slightly, 0.2% for the week, up 4.26% for the year. So overall, that is a report of the general markets. Now let's see what our analyst had to say for us this week. All right, so. Our analyst writes, both U.S. and international broad equity markets. Remember, when you hear equities, we're talking about stocks. Equity markets finished the week with solid gains near record highs. The large tech and AI names continuing to lead the market. While equity markets, again, stock markets, were strong and did not seem to be impacted by the government shutdown, we saw several indications of flight to safety reflected in the bond market. Gold hit some record highs, and the U.S. dollar. So I'm actually a little surprised that we're not seeing a bigger market impact from these shutdowns, especially where discussions have been going. But it just shows a lot of resiliency in the stock market, which is a good thing. I always say, let's be defensively optimistic. We want the market to perform well over time. Listen, all the time. I want the market to perform well all the time. I'm just always ready for that 30% shock, right? That 30% downturn. Fixed income markets. So fixed income or bonds. Fixed income markets were positive and gold prices continued to climb. Treasury yields. So these are bonds issued by the U.S. Treasury, were volatile, moving lower on weaker jobs data, but stabilizing due to demand as a safe haven asset. So again, when there's some concerns about market volatility, people move to things like treasuries and gold. As an example, the 10-year Treasury ended the week with a yield of 4.18%, down from, I think she has this reverse, 4.21% the prior week. The U.S. dollar was mixed, impacted by softer labor data and government shutdown uncertainty, finishing the week down 0.44%. So that was the dollar. The shutdown delayed or suspended official economic releases last week. That's jobs, inflations, and trade data. Because much of the data releases are produced by federal agencies, providing the market less clarity. So there's some concern about that. Analysts expect up to $7 to $15 billion per week in GDP loss if the shutdown persists. Ooh, that's big. So what do we have this week? Today we have the Fed meeting, right? Minutes. So we see the FOMC minutes from the September meeting. They're scheduled to be released. Tomorrow we have initial jobless claims, and then we have the Fed chair is going to give a speech. And Friday we see the University of Michigan consumer sentiment, and then we see the non-farm payrolls and the unemployment rate. So again, some of these might be delayed or incomplete because of the shutdown. So what are the big firms saying, the large firms and other analysts? So J.P. Morgan keeps their bullish position. So the JP Morgan's capital market outlook, the base case, they say, is that markets can reach new highs over the next 12 months under a backdrop of lower interest rates, looser regulations, and favorable policy shifts. The SIFMA, which is the Securities Industry and Financial Markets Association Chief Economist Survey, In a poll of chief economists last week, forecasts were revised higher. 2025 real GDP forecast rose to 1.5%, up zero point 0.6 percentage points from mid-year to 2.2. Most now expect 3 Fed rate cuts this year, with Fed funds landing in the 3.0 to 3.75% range. Nationwide, the investment company, Nationwide chief economist argues that despite the shutdown, investors are not likely to abandon equities against stock. So the chief economist at Nationwide thinks that people are going to hold their stock positions even if we have a prolonged government shutdown. Now, on the bearish side of it, the people that are more concerned about the markets, Goldman Sachs CEO David Solomon expressed confidence in the broader market, but warned that a drawdown is likely over the next 12 to 24 months, drawing parallels to past tech booms. So that's something I like to pay attention to, because we are having significant run-ups, and we've seen this before. And when people start talking about these bubbles, we can't. I'm not looking for predictors, but I'd like to pay attention to it. TD Securities said that the shutdown is more likely to extend, potentially delaying key data releases and complicating the Fed's picture for sure. This warns that the markets may face an information drought, which increases uncertainty and could create more volatility. So all good insights from our Chief Investment Officer, Lydia. If you're a client and you haven't watched the recent webinar I did with Lydia, you should go back and watch that. If you're a prospective client and you'd like to see it, let me know. I'll just send me an email at questions@attleborowealth.com. That's questions@attleborowealth.com, and we can send that to you. Okay. All right, so from here, we are going to go into our financial focus section. So this is the financial focus portion of our weekly webinar. So I've just went over some key items. I read some updates from the Slott Report, and I went over some thoughts on investments and reports on investments. I read our analyst reports, but on the last section of our webinar, we dig into a financial planning topic. And today's topic for our financial planning, for our financial focus, is tax-free transfers from IRAs, retirement plans, and more, and other types of investment vehicles. So I like to share my whiteboard. So I'm going to share my whiteboard. And of course, if you're just joining us and if you haven't already, please hit the like, subscribe, and notification buttons. All right, so let me share my whiteboard here. So we're talking about tax-free transfers. Now, listen, this does not mean that these things are tax-free forever. And remember my goals for you as listeners. I want you to stay educated. This is education, not advice. I want you to stay updated. I want you to stay motivated, and I want you to open your mind about different ways of doing things. But just pay attention that while a transfer may be tax-free in this year, it doesn't mean that it's forever tax-free. So there are some things like Roth conversions where you pay the tax now, and as long as you meet the requirements, you never pay tax again. But that is not what we're talking about today. We're talking about transfers from one type of investment to another transfer, and what you're really doing is deferring that potential tax. Now, there are things that you can do from an estate planning point of view that may help where you'd further delay that tax or maybe never pay that tax. But right now we're talking about deferring or delaying tax. So the first we're going to talk about here is IRAs. We're going to talk about IRAs and retirement plans. So the first thing I want to talk about, and let's make sure that we put a link in the description here. I have a whole video that I did last year about 60-day rollovers, and I got more in depth about what is a 60-day rollover, what are some of the things to watch out for, what are some of the exceptions to the 60-day rollover. I even went over the form that you can fill out. So we'll put the link in the description here for 60-day rollovers from, I think it was the end of the year last year. But what a 60-day rollover is a transfer from an IRA to an IRA with a stopover. So what do I mean by stopover? It means that you accept the funds. If I have an IRA account, let's say I have an IRA CD at my local bank, and I want to take that CD when it matures, and I want to invest it into my investment account at, let's say, for example, Vanguard. Well, instead of doing a transfer from the bank directly to Vanguard, I say, I'm going to make this easier on myself. I'm going to receive those funds. They're going to make the check out to me. And then I'm going to take that check and I'm going to deposit it into my Vanguard account. Now, you have 60 days. It's called a 60-day rollover. You have 60 days to do that. There are other times, and if you follow the rules, then that can be a successful transfer. If you take the check out in your name and you redeposit it into the Vanguard, for this example, IRA, within that 60-day period. But what happens if you go out 61 days? Well, that's where the problem is. And then there's other issues there too. Some people see this as I've heard this over and over again. I'm going to take a 60-day loan from my IRA. I had somebody who sent a question in one time and they said, I used my 90-day loan from my IRA to buy a car and now I think I have a problem. Well, they have a huge problem because there is no 90-day allowance from a distribution of an IRA to redeposit those IRAs. So that's, try not to get cute with these rules and, think about this 60-day loan where you're taking money from an IRA and you're spending it. A lot of people use this for real estate purchases. They'll say, okay, I'm going to take this loan. Sometimes it's significant. Sometimes it's hundreds of thousands of dollars. They take this distribution from their IRA and they say, I'm going to use it as a down payment or to buy this house. And then once I'm able to take money from elsewhere or sell my house or get a loan, somehow they're going to replenish those funds. The problem is, what if they don't? What if they miss it? So what if I miss it? What if I miss the 60 days or violate another section of the rule? Well, that distribution is taxable. So let's say, for example, I want to buy a new house and I have $300,000 in my IRA and I say, well, wait a minute. I don't have to really, I can give myself some time. I can use this as a bridge loan, quote unquote bridge loan. I can buy that house for $300,000 and then I can wait until I'm selling my house, or I can, my mortgage will be together by then, or whatever the situation may be. And I'm going to put that money back into my IRA. Well, if I miss it, then that whole thing is taxable. So that $300,000, for example, now I pay tax on. So this all becomes taxable income in the year that it was done, and it's taxed as ordinary income, just like I earned it. So could that mess up your tax planning for the year? Well, it sure could. Absolutely could do that. So you want to pay attention to that. So before I go into exceptions, let's talk about the 1 per year rule. The other thing that I see people mess up on is maybe they'll say, let's say the loan's not that big or that distribution's not that big. For whatever reason, they'll take a distribution. Let's say their first distribution is $5,000. So whether they're going to roll that first distribution over or whether they're going to spend it. So let's say we're going to do the $5,000 rollover, right? So we're going to say, okay, well, I'm going to roll my banks. Let's go back to the bank CDs. Let's say you've got 2 bank CDs. CD 1 is for $5,000 and CD 2 is for, let's call it $100,000. So you say, and it's 2025. So on, it's 10/8. So on 10/8, this CD comes due. And you say, okay, I'm going to take a distribution. It's a bit of a pain to move these things directly from the bank to Vanguard. So, and I'm just using that as an example again. Could be anybody. And so I'm going to take a distribution as the $5,000. I'm going to roll it. I'm going to deposit it right in the Vanguard. And you do that within a week. You're way ahead of the 60 days. And then you invest that into another IRA. So it's an IRA at the bank. You take the money and it goes into an IRA Vanguard. You've met the requirements, right? So you're within that 60 days. Now you say, okay, that worked pretty well. So now let's say 6 months later. So what would that be? That would be April. So I think that's April 8th of now we're in 2026. So 10/8/2025. Now you say, you know what? I have this other CD that's due for $100,000. Now that last time worked pretty well because it's a little bit of a pain to move the money directly from the bank to my IRA investment account. I'm just going to take a distribution. I'll take it in my name and then I'll put it into the next account. So I take it from an IRA, I take it to me, made out to me, and then I put it into my IRA. So what's the problem with that? Well, now you violated the rule. You violated this 1 per year rule or once per year rule, because it's not, remember, October 2025 and April 2026. It's not calendar year, it's 365 days. So this was a tax court decision. That's one of the reasons it's very specific, but that is a true rule. So what happens if you violate that? Well, in this case, that $100,000 would all be taxable in that year. So in 2026, you're going to have an extra $100,000 in taxable income. And that's not the worst part of it, is that what do you do with that now? What do you do with that $100,000? Can you put it into an IRA? No, you can't, because that would be an over contribution. You can only contribute so much, and you can't have too much income. There are some requirements around that. Now, we've seen this in the Slott group, and we've seen people make mistakes like this. And one of the remedies sometimes is, well, okay, if it's going to be a taxable distribution, you might as well convert it then and send it to a Roth IRA. But don't put yourself in that position. And I went to the IRS website, and I grabbed this information for you. There are 3 ways to obtain a waiver of the 60-day rollover requirement, because what happens if you violate that and now you're subject to tax? Well, there are waivers, but let's talk about it. You have to qualify for an automatic waiver. So there are exceptions. And again, you can go to that video I did in 2024, but again, they're very specific. You request and receive a private letter ruling granting a waiver. This was actually the most common private letter ruling. That's why they have this self-certification and these automatic waivers. So private letter rulings are costing about $15,000 right now. So if you make that mistake and you have to pay that tax on that distribution, and it's a distribution, then you're going to have to pay for this private letter ruling. Or you can self-certify that you met the requirements of a waiver, and the IRS determines during an audit of your income tax return that you qualify for a waiver. Well, that sounds like a real pain in the neck, doesn't it? So just avoid it altogether and try not to use the 60-day rollover rule. But that's the one way that we can, in fact, transfer funds from one account to another without paying taxes immediately. Now, to make things a little confusing, there's other types of rollovers. So we talked about the 60-day rollover. Well, we have retirement plan rollovers. Retirement plan rollovers are a lot simpler because there are rules that they have to follow. I've never seen a non-trustee to trustee transfer. What does that mean? Like, it's coming from, your Vanguard or Fidelity 401k or whomever your 401k is with, or your retirement plan, and it's made out to your IRA account. There is no 1 per year rule. It doesn't exist with retirement plans. There's also no 60-day rule. So you can transfer or roll over as many times as you'd like from a retirement plan within that 365 days. And you don't have a time limit. You can take that check that's made out to the custodian and hold it for as long as you want. It doesn't make sense to usually, but there's no 60-day requirement. Calendar year requirement doesn't matter. And certainly the 365-day 1 year per rollover rule. So if you had $5 million in your 401k, for example, and you wanted to transfer that over a 365-day period at $1 million at a clip for 5 times, 1 million, 1 million, 1 million, 1 million, and 1 million. From a retirement plan, that's not an issue. From a 60-day rollover IRA, it's a huge issue. That would be all this would be taxable income. That would be a huge issue. All right. So then we have direct transfers. So a direct transfer is IRA to IRA. We're talking about traditional IRA or Roth IRAs. So what that means is you have an IRA at, let's call it Schwab. So Charles Schwab is your custodian. You have an IRA in your Charles Schwab holding, and you want to transfer that to Merrill Lynch. So the Schwab does a direct transfer from your IRA direct to your Merrill Lynch IRA. Now, it is an IRA for the benefit of you. So your name is on that. It doesn't go into Merrill Lynch's general account or anything like that. It's an account specifically for you, but it is a direct transfer, custodian to custodian. A custodian is simply one of these big firms that holds your money for you, does your statement reporting, your tax reporting, etc. This is the best way to truly transfer IRAs to IRAs. Please try to avoid the 60-day rollover. There's just too much room for that to go wrong. So think about the using a direct transfer, custodian to custodian, and that could be for Roth or traditional IRAs. There are no, as I said, there's no once per year rule with direct transfers. You can do as many as you'd like. You could go back and do this. Well, if you want to move $5 million from your Schwab IRA to your Merrill Lynch IRA, and you wanted to do that 5 times in 6 months or in 1 year or in, within that 1 year period, you could do that. Do you have to do it, within 60 days? No, there are no requirements with these direct transfers. So that is for IRAs and retirement plans. Now we have non-IRAs and retirement plans. So let's talk about non-qualified. So when you see non-qualified, think non-IRAs. So we have non-qualified annuities and life insurance. So if you take a distribution from a non-qualified annuity, you will pay tax on the gains. And it's not a good tax, right? It's not even, no tax is good, but it's not even capital gains tax. It's ordinary income tax. So if you put $100,000 into a non-IRA, a non-qualified annuity, and it gains $25,000, and you take a distribution, you're going to pay tax on that $25,000 just like you earned it. And if you're under 59.5, you also are subject to a 10% penalty. It kind of grabs the rules around an IRA distribution, but we're not talking about IRAs. We're talking about non-qualified or non-IRAs. So when you see non-qualified, think non-IRA annuities and life insurance. I don't know. Life insurance can never be in a retirement account. Geez, not that I've ever heard of, but if somebody's ever heard of that, just let me know. But non-qualified annuities and life insurance. So again, taxes on distributions are ordinary income, just like you earned it. So that $25,000 I used as an example would flow right into your, we talk about that graduated cylinder marginal tax brackets. That would flow right into that, and you would be taxed just like you earned it. There isn't a section in the IRS code that allows for tax-free exchanges, really tax-deferred exchanges. So that is IRS Code Section 1035, also called 1035 exchanges. So it allows tax-free and tax-deferred exchanges of gains. It must be a like-kind exchange, which means you have to, you can't take an annuity and exchange it into a stock account and protect the gains. It has to be annuity to annuity or life insurance to annuity. It can never be annuity to life insurance. And it can also be life insurance to life insurance. So the benefit here is if you if there's a good reason to switch from an existing annuity you have to another annuity, then you don't have to worry about the tax because there is this section 1035. And again, you hear the 1035 exchange. I hear that, I show that in quotes. That allows you to do these transfers or exchanges without paying that tax immediately. This does not apply to IRA annuities. So IRA annuities held in IRA accounts follow these rules, right? Direct transfers, IRA to IRA. So if you wanted to transfer an annuity you have in an IRA to another annuity in an IRA, that would actually be a transfer, not a 1035 exchange. 1035 exchange is only for non-IRA, non-qualified annuities. Again, it has to be a like-kind exchange, annuity to annuity, life insurance to annuity. Cannot be annuity to life insurance. And again, let's put our logic hats on here. Distributions qualified proper distributions or properly structured, I'll say distributions or withdrawals. Let me put it that way. Properly structured withdrawals from life insurance or death benefit proceeds from life insurance are tax-free. So, I remember when I was studying for my CFP exam, and this item was in there about, what can be transferred in a 1035, annuity to annuity, life insurance to annuity. And one of the sticking points was the annuity to life insurance that I don't remember if I was having issue with it or somebody else, but I remember the conversation being, if it's going to be a tax benefit, it likely isn't allowed, right? So the annuity, if you take an annuity with say $100,000 in gains and transfer it to a life insurance contract, and then that life insurance contract has the ability to pay that out tax-free, or distribute it tax-free, and there's no tax in between, then it doesn't work, right? It's different with Roth conversions because you pay tax during the transfer, but no annuities to life insurance is allowed. And we can also have life insurance to life insurance can be done under Section 1035 via 1035 exchange. With life insurance and annuities, you have to pay attention though. We're talking about tax deferred or tax-free exchanges here. There are still potentially surrender charges and other costs to doing these exchanges. So if you're going from a non-qualified or non-IRA annuity to another non-IRA annuity and you're avoiding that tax for now by doing that transfer, then that's fine. You don't have to pick up the tax, but pay attention to the surrender charges or other costs of that exchange. So I found here a good takeaway here. This is from Investopedia. So let's go through this. So key takeaways. You can look this up yourself. A 1035 exchange allows tax-free transfers of life insurance policies, annuities, or endowments to similar products. That's that like-kind exchange, provided that ownership remains unchanged. That's important. I didn't mention that. Ownership has to remain unchanged. So it has to be, again, like-kind, and it has to be same ownership. So I can't transfer my annuity to my kids, for example, and avoid that tax on that transfer. While avoiding taxes, contract holders still need to consider fees and surrender charges. We talked about that, which may not be waived by insurers during a 1035 exchange. Partial exchanges differ in tax payment as only a portion of the cost basis transfers to the new product. So there's no cost basis when you're talking about IRA accounts and annuities, typically. Unless there's some after-tax contributions in there. But when you're talking about non-qualified, non-IRA annuities and life insurance, there is a cost basis. So that you've got to pay attention to see how that basis transfers. Transfers between qualified accounts like IRAs and 401ks do not qualify as 1035 exchanges and cannot include annuity to life insurance swaps. Reporting a 1035 exchange on tax returns is mandatory, though in-house exchanges may not require a 1099 form. So what's an in-house exchange? If company ABC, insurance company ABC, has an annuity that they allow you to swap within the same company, then it may not, or exchange, within the same company, then it may not generate that 1099-R. All right, so that is 1035 exchanges, and they're, again, for non-qualified or non-IRA annuities and life insurance. Now, real estate. This is a big one. And I'm going to do a whole, if I haven't done it already, I'm going to do a whole video on 1031 exchanges. So you'll hear these referred to as 1031 exchanges, and that comes under IRS code section 1031. That's where these things, when you hear these numbers, that's where they come from. 1035, 1031, 401, 401k. 401, that's section 401, subsection K. So that's where these numbers come from. So when we sell real estate, we have tax on that sale. So there's some exclusions for personal real estate, but we're talking about investment and business real estate. So there's a tax on that sale, and the tax is some form of capital gains. So this is what people are looking to delay when we're talking about capital gains. And this is an important one because I can't tell you how many times I've heard people say, I sold my shore house. And I bought another shore house. Now, the shore house is an investment property. It can't just be, your vacation home, but it's an investment and certainly can't be your primary home. But let's just say, for an example, it's an investment property. So I put the money in the bank, sold it, bought a new one. And I would say, did you use 1031 exchange? And they either say, no, I don't know what you're talking about. And I tell them what I'm about to tell you. Or they say, yeah, I'm considering it. But if the money's in the bank, you can't use it. You can't take ownership. You can't take possession of that money. So, but if you, and therefore it's going to be taxed as capital gains. So if you bought a shore house for $100,000 and you sell it for $1 million, well, you've got $900,000 of capital gains there. So it's important, especially, when you're considering changing, investment. Sometimes, you want a different kind of property. You want, a different kind of maintenance or something like that, or you just a different opportunity, different location, whatever it might be. There might be opportunities for you to sell one investment property and purchase another one, or multiple ones. And you may be able to use this section of the IRS code. It has to also be a like-kind exchange. Now, I'll tell you that it gets much more complicated with 1031 exchanges. You have to use a intermediary, so you can't hold the funds. You've got to deposit the funds with somebody else. There's some identification timelines, and we're going to go over those briefly here. But if you're considering selling a piece of real estate investment and you want to take advantage or just work through if this 1031 exchange process makes sense for you, you should pay attention to it. If you have questions, you can reach out to us at questions@attleboroughwealth.com. That's questions@attleboroughwealth.com. So let me go over what I did is I pulled up the publication here, or the fact sheet from the IRS. And I just highlighted a few things for you regarding 1031 exchanges. So the first is the exchange can include like-kind property exclusively, or it can include like-kind property along with cash, liabilities, and property that are not like-kind. So there were some significant changes from the Tax Cuts and Jobs Act that removed almost everything but real estate. There used to be some opportunities for airplanes, things like that, but that's all gone now. Who qualifies for the Section 1031 exchange? Owners of investment and business property may qualify for Section 1031 deferral. Individuals, C Corps, S Corps, partnerships, general limited liability companies, trusts, and or other tax-paying entities may set up an exchange or business or investment properties for business or investment properties under Section 1031 exchange. So, but it's got to be an investment or business property. What are the different structures? There must be an exchange of properties. You can't take cash. I'm down here now. The disposition of the relinquished property and acquisition of the replacement property must be mutually dependent parts of an integrated transaction constituting an exchange of property. There's very strict rules. There are facilitators that do this for a living, and I recommend using those facilitators to make sure that you don't violate it, because if you violate it, what happens? All of your proceeds are subject potentially to tax. Potentially all your proceeds are subject to tax. What property qualifies for a like-kind exchange? Both properties must be held for use in trade. Right here, both properties must be held in use or trade, for use in a trade or business or for investment. Both properties must be similar enough to qualify as like-kind. Like-kind property is property of the same nature, character, or class. So it doesn't mean that it has to be, a 10-unit apartment building for a 10-unit apartment building. It has to meet the qualifications of the like-kind exchange. So let's talk about what does not apply. Because again, people try to get cute with this. They'll say, all right, well, I'm going to sell this investment property, but I want to buy, a hot stock. Well, inventory or stock in trade, stocks, bonds, or notes, other securities or debt. I'm down here. What does not apply? Inventory or stock in trade, stocks, bonds, or notes, other securities or debts, private interest, certificates of trust. There are time limits. The first time limit to pay attention to is that you have 45 days from the date you sell the relinquished property to identify potential replacement properties. Honestly, you should be doing these things simultaneously, because 45 days is no time when you're talking about potential investment properties. The identification must be in writing, signed by you, and delivered to a person involved in the exchange, like the seller or the replacement property or the qualified intermediary. This is that qualified intermediary I talked about. The second time limit right here is that the replacement property must be received and the exchange completed no longer than 180 days after the sale of the exchange property or the due date. Are there restrictions for deferred or reverse exchanges? It's important to know that taking control of cash or other proceeds before the exchange is complete may disqualify the entire transaction from like-kind exchange treatment and make all gain immediately taxable. So it's really important to do this correctly. All right, you can read this information yourself if you'd like. There are some reporting requirements. It goes on to how do you report Section 1031 like-kind exchanges. So that is Section 1031 exchanges. Let me come back to my notes. So again, that's primarily real estate. So pay attention to that. People confuse these. I hear these switched all the time. 1035, 1031. It's not a big deal as long as you know what you're talking about. You know, when somebody says, I'm going to sell my property using that 1035 exchange, or I want to exchange my annuity using a 1031 exchange, we know what they're talking about. But you know, make sure if you're diving into this that at least you have somebody helping you who knows what they're talking about, or that you understand the rules. So that's a breakdown of how you can transfer things without paying immediate tax. Now, again, all of these, with the exception of Roth IRAs and properly structured life insurance, you're eventually going to have to pay tax on. But you can tax plan around these transfers and exchanges. So IRA to IRA transfers, 1035, 1031 exchanges give you the opportunity to plan your tax. And you know, sometimes you can defer it, delay it forever, right? But I hope that was helpful today. That's the webinar for today. We have some announcements. Let me just go over my announcements. We have some things coming up. We have a special event coming it'll be 3 weeks from tomorrow. So here at our office at 1051 Lindenhurst Road, we're going to be hosting a paper shredder event and a electronic recycling event from 11 to 2 on October 30th. We're also going to have a food truck here. So you can come here if you're a client, and limited community. We have to limit the number of people. All clients are invited. There's some limitations in the amount. I think they're limiting. The shredding company said no more than 4 office boxes per person. So try to pay attention to that. And there are also some requirements that you'll see on the email that's sent out to you if you're on our email list with the list of what's able to be recycled for the electronic recycling. I know that's a big one, right? Because I have things that I want to recycle, and that's actually what started this whole thing. Is I said we need to get a recycling truck out here to recycle some of these electronics, and we turned it into a client event. So it should be a really, I hope this is helpful, an helpful experience for you. So bring your documents out that you've been holding on to, for up to 4 boxes of documents, and the electronic recycling. Again, there's going to be a list on email list, and clients get first dibs, folks. So we only can host up to 100 people. That's a lot, but clients get first dibs, and then we're inviting certain community groups. But if you're on our email list, you're going to be getting an email by the end of the week for sure. Otherwise, if you have questions about it, you can reach out to us. I hope today's webinar was helpful. I look forward to seeing you all next week. And if you have questions, you can reach out to us at questions@attleburowealth.com. If you have at least $1 million in your investment accounts and you want to schedule time with me, you can go to our website at attleburowealth.com and schedule a discovery phone call, and we'll see if we can help you. And if you can't find time on the website there, well, you can go to questions@attleburowealth.com and schedule time there. So I hope that was helpful today, and I hope you all have a great week. Take care.